Hey everybody, good to be here today. My name Brent Moores, and every week this time we have advanced option strategies. Glad to be here. We're changing our webcast schedule a little bit come the new year. This is actually staying put. I'm still going to be teaching this class and same time slot and everything. So, we'll go with it. Next week we will be. I think we will be off next week, but then after that we're back to normal. So I'm joined alongside Mr. James Boyd in chat, and appreciate James. Hope he's healing well from his surgery. And so as you have questions, feel free to type those questions to James or myself. You can also follow us on X at BrentMooreCS, at James Boyd CS. Today, I want to talk about the market and trading according to the market, in particular according to the implied volatilities in the market here. So we'll do that here in just a little bit, but let me go through a few important disclosures first. Options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only, and it's not a recommendation of any security strategy or chart type. The paper money software application, which we'll be using, is for educational purposes only. And for the sake of simplicity, I'm not going to factor into fees and commissions in everything we do. Just realize those do exist and you need to factor those in. All investing involves risk, including risk of loss. Rolling strategies, we may do that, can entail additional transaction costs, including multiple contract fees. So be aware of that. Probability analysis results are theoretical in nature. There's no guarantee a stop order will execute at or near the stop price. And look, we're going to look at individual symbols. Those are not they're not a recommendation. This is the S&P 500, everybody. And if you were, sleeping at the wheel this week, so to speak, we had a big drop earlier in the week. A lot of that was driven, it seems, the Fed made their announcements. They cut 25 basis points off the Fed funds rate. No, surprised nobody in that. And then what they did is they actually made some commentary, which is what the market did react to, in a large part at least, to this coming year. They said in 2025, they're forecasting a couple additional rate cuts, but that is less. That's fewer rate cuts than the original, the original indication was going to be 4. So they cut that in half, which maybe, that's significant. I don't think we can be super surprised by that, to be very honest, because all along they've been kind of revising what they've been doing. They've said all along they're data dependent, and inflation hasn't been subsiding as much as they had hoped. But I think really what it is, before we get to actually trading and looking at this stuff, is a lot of it is that that's part of the bigger picture. And part of the bigger picture was that the markets have been really hot we had a spectacular year for the most part for 2024 and 2023 as well. And so, people are a little concerned about valuations. That was a reason for a sell-off, right? So here we go. This was the sell-off we had. Nice big red candle. Yesterday, down a smidge, not much. And today, we'd call that a bullish engulfing candle right now. So what the market's going to do, I don't know, but a lot of times that's a reversal candle. A bullish engulfing candle after the pullback is often a shorter term reversal candle. Okay, and what we can see here also on this, as we're just looking at the market as a whole here, is what we can see is low, higher low, higher low. Is this going to be the higher low? And let's go for, I don't know for sure. That's kind of what it looks like, but we'll see. I don't know. If you look at the NASDAQ, you're going to see a similar type thing. Here's the NASDAQ. Looks like a very similar chart, doesn't it? But let's look at the VIX, because implied volatilities can certainly affect our options decision making. Higher implied volatilities tend to benefit selling strategies. Okay, selling strategies. So the VIX right now is around 19.5. It's down from the peak we had a couple days ago, but it still is right here is elevated compared to most of the year. I mean, we've had a few spikes above that, but we're still relatively elevated on the VIX. And if you're interested, you can look at essentially the VIX on the NASDAQ, if you want, the NASDAQ 100, and you can see it's a little bit higher, right? Not surprising. NASDAQ stocks tend to be more volatile, just as a whole, than your typical S&P 500 stocks. So your VIXN, VXN is showing higher as well. But we're going to try to take advantage of that in some of our trade examples today. Okay? Hopefully that is making sense. So what I'm going to do is I'm going to go to a NASDAQ watch list, first of all. And when we look at these stocks, I'm just going to pull up Tesla here just as an example to start. What I'm going to do is I'm going to bring up implied volatilities on that NASDAQ 100. So here's the implied volatility on the NASDAQ 100. And you can, not on the NASDAQ 100, on the Tesla chart. And you can see, hey, it has spiked. It's very high compared to where it's been. They had a big run up and a little bit of a pullback. And you can see that IV there. So, so there you go. That's for selling options. This may be a time where options traders look to do so on this as an example. Now, there's different ways to do it. If you just bring up a watch list over here, I'm going to make it just a little bit bigger for you. So here's a watch list. I'm going to customize this guy. Customize. I'm going to get rid of today's change. But you can go to IMP volatility. Okay, and let me just reorder these here. And so this implied volatility is just basically the average implied volatility for this stock, for the options on this stock. And it goes across different months, different strikes. That's an average. And let me just kind of shrink this down so you can see it a little better. And here's the implied volatilities that you can see that, like 77 on Tesla, which is fairly high. But one thing we like to do on implied volatilities is go not just where they are, but where they are compared to their own history, right? Some stocks have a higher implied volatilities in general. Well, so you can also do a column called IV percentile, IV underscore percentile, if you want. And what this is doing is it's comparing the implied volatility compared to its own history. Okay? So Tesla at 88 percentile is basically very high compared to where it's been. It was higher a couple days ago, but it's still very high. So what I'm going to do today is I'm going to go through our NASDAQ list, and I'm going to look for those IV percentiles that are a little bit higher on the list. Okay? So that's going to be our starting point. Now, just because it's on the NASDAQ, and here, this stock's been going down, so I'll probably be looking for more of a bearish trade on this because our general trend is down on this, okay? Now, if you want to use moving averages or something like that, look, here's a 10-day moving average. You can do that. The 10-day is in green, the 30-day is in red, and the 10-day is an exponential, by the way. You can use that, but you probably don't even need to do that to say, hey, this chart is heading down, okay? And we're going to kind of primarily use the trend to base that off. And you can see our implied volatility is fairly high. But this isn't enough to do a trade. We need to make sure our liquidity is decent. And so this is Regeneron Pharmaceuticals, higher implied volatilities. You can see those implied volatilities over here. And by the way, that one options that expire today, in other words, in a couple hours, essentially, have this, very high volatility, but even across the board, it's here. So you can't really judge it by this because we're probably not going to do options that are going to expire in less than 2 hours. But if we're looking at bearish trades, let's just go out to the monthly contracts. I'm going to shrink this down just a little bit. You can look down here, and if I'm just looking at puts, you can see we have a pretty big bid-ask spread here on these. Okay, $27 to $21, probably too big. And if I'm doing, say, a short call vertical or something like that to take advantage, selling a call vertical, $30 to $25, that is too big, too large of a bid-ask spread. Now, these are monthly options, which typically have better liquidity than the weekly options. So we can glance at the weekly options and you can see they're not really any better. Okay, not surprisingly, they're not better. So it doesn't matter how bearish I am on the chart, or you are, or whatever your forecast is on the chart. Some stocks probably aren't the best for trading options just because of liquidity issues. Just because it's on the NASDAQ 100. It's a bigger stock, bigger company, bigger name maybe. If the liquidity is not there, we're going to pass it up. Okay, I had a sense on Regeneron that's how it was going to be. Now Honeywell's a little bit better here on this. Now what I'm going to do on this is I'm going to say, here's Honeywell, and I have a pretty good support level here. We got down to it. We touched it today. I'll just zoom in a little bit so maybe you can see it a little more clearly. We touched that right here, just a little kiss off that support level, and a bounce up off that. We've hit that support level multiple times. Seems like a reasonable support level. I'm going to go with the thesis here that this support is going to hold. So I'm going to take more of a bullish position here. Now, do we have some potential resistance up here? Yeah, but that's quite a ways up above where it's at. And so implied volatilities, well, higher implied volatilities. Why? We know that because I've sorted this list by that IV percentile. This is in the 73rd IV percentile, so higher implied volatilities for this stock. So let's look at a bullish stock that's going to take advantage of the higher implied volatilities. By the way, when we are selling options, it's not just that the implied volatilities are high, because we can sell for higher premiums, but ideally those implied volatilities go down after you have made the initial sell of those options contracts. Because then they become, because then they get cheaper to buy back at that point. Okay, So in any case, that's how that works out. Okay, so I'm going to go to the trade tab, and I'm just going to look for say a short put vertical because we're going to be bullish on this, and I'm going to go out. Maybe I won't go out that. I'm not going to go out too far. Let's go out January contracts. Look at our bid-ask spread here, about 25 cents. That's not terrible on a $2.80 option. It's not great, but it's okay. I'm going to call that decent, and I'm going to sell this contract here. Okay, I'm just going to start us off with the short put vertical. And when I do so, what I'm going to do is I'm going to click on confirm and send. I'm going to look at my max profit, which is $137, divided by my max loss, which is $363. That's about a 38% return on risk. Now you may be saying, look, I want something higher than that, but keep in mind, that's the price we're paying for something that's out of the money. That is, let me just double check. What was our strike? A 225 strike, 35 delta. So that kind of implies there's about a 65% chance. Implies there's about a 65% chance it's going to stay out of the money there. Now, our break even isn't exactly at the strike price. Our break even is going to be the credit we bring in, the strike price minus the credit we bring in. Okay, so I'm just going to sit down and get us started off with that today. I may do more than one contract here. We'll do 3 contracts. That's going to bring our max loss right around $1,000 on that. Okay, so I'm going to click on send, and that filled there. That is Honeywell. That's our first trade for the day. Let's look at another trade. And so let's go down our list here. Higher implied volatility stocks. Here's a bearish one. Bearish, I'm judging by the trend here. And so implied volatilities, again, you can see our implied volatilities are fairly high. In this case, we'll start it off with another relatively simple type trade, a short call vertical. I'm going to go to the trade tab. I'm going to go out to January 17th, just because I know with Biogen, traditionally at least, when I look at these, our bid-ask spread here on some of these is just not very good here on the weekly options. Here's the 155 contract, 340 by 135. That's just not going to work for our purposes here. And this may not work either. 290 by, I may skip this. 420 by 450. So that's probably okay on that for a short call. That's a little bit higher delta, which means we're going to get more premium on that, but it's also a greater probability it's going to work against us. So for those of you who are newer, I'm looking at delta, and delta just basically tells you how much that option contract is anticipated to move in relationship to a dollar move in the underlying stock. Stock moves $1, we expect that option contract to move about 42 cents. But another way to consider that is it's going to give you about approximately the probability of it expiring in the money here. So 42% chance expiring in the money, that implies about a 58% chance out of the money. So we'd still call that a higher probability trade. But we need to make sure a 150 strike price seems acceptable. Let me just draw a line right at that 150 level here. So we have to ask ourselves, we'll call that close enough, are we comfortable with this stock staying below here? If the answer is yes, this is a viable trade. We should get some benefit by declining implied volatilities. In fact, we may be able to see that here. Let me just pull this up real quick. I'm going to just add the trade in, and then we'll analyze that trade. Let me go hold down my control key. There is our spread. I'm going to right click on this, and I'm going to analyze this trade. And one thing I can do is I can then look and I can adjust that volatility if I want on this and say, look, what if that implied volatility drops for me? So I'm going to assume a similar volatility drop on both contracts. How big a drop are we looking at though? Well, look, a more normal volatility is down here, we'll say about this level, around the 29 level. Right now it's about 36. So I'm going to say about a 7-point drop in implied volatility. I can model that right here. And notice as I drop this implied volatility, it will change our PL open here. So we're going to say, I think a 7-point drop in implied volatility and see how that affects it. So it affects it a little bit. Assuming the stock stays right where it's at, just because of implied volatility, that's showing about $10 versus if we had no change there, losing about $5. So it's about $15 worth of benefit to us in terms of implied volatility. Now, is $15 a huge deal? No, $15 is not a huge deal, but keep in mind, we're talking on a $145 trade, a 145 credit. So that's about 10% benefit to us, I guess, is one way to approach that. So it's not a make or break thing necessarily, but it's a nice addition to the trade if we're going to do that trade there, that implied volatility benefit, assuming implied volatilities go to where there are more average level on that. Obviously, if they go lower, it would benefit us even more here on that. So what I'm going to do is I'm going to throw that trade in here, and then we're going to get to some more complex trades, perhaps, as we look at this. So that was Biogen, that was Biogen. Let me just let's keep on going down that list here. Let's see, Fastenal. And you got to decide what kind of trade you want to do on these. I was looking at Meta earlier. Here's Meta. And I'm going to do more of a neutral type trade on Meta here. And the reason is this. Yes, we have had a kind of a longer term trend up on this, but this really has moved up a lot. I mean, if you want to see, say, a percentage chart, year-to-date percentage, how has Meta done? Meta's up 72% this year. How would you like to have known about that going into the beginning of 2024? 72% on a stock that, was already a kind of a high flyer over the past 10 years or whatever. So that's pretty incredible. So if you think it's going to go up another, that much more, you may just buy the stock, or you may just do a long call or something like that. But there you go. That's how that is. Now, David said in the chat, and Thea has a good question too. Well, let's talk about implied volatility a little bit more here. Okay, so I use the absolute drop in implied volatility, not the percentage. I did, yes, on that page, okay, on this page over here, I used the volatility adjustment here. Okay, so this is a good question. I probably went through this a little fast. This is changed. So we assumed about a 6% drop in implied volatility. Well, that's how you do it on this page. Not, it was 36, now it's 30. That's a 20% drop, percentage change between 36 and 30. No, you just put the actual, the percentage drop in the implied volatility. Okay, so good question, David. Now, Thea said, what's the difference? Go over the difference here between this implied volatility and this IV percentile. Okay, good question. This implied volatility is the average implied volatility for the stock. Okay? It's just the average. So implied volatility is a measure of how expensive these options are on a stock. Okay? And why are some options more expensive? Because people expect more volatility in the going forward. Anticipate more volatility. It's not backwards looking. Anticipate more volatility going forward in a stock. So that's why before earnings, implied volatilities will be higher, because we expect more movement in that stock. And then after earnings, even though the stock just had big movement, we expect less there. That's what this column is, the implied volatility. This column here should match the implied volatility if I add it to a chart here, okay? So here's my implied volatility right here, 36%, 36%, okay? Then what is this IV percentile? The IV percentile, well, it's a percentile. Way back when, for some of us, including me, it's more longer in the past, but you may have taken a standardized test. I took an SAT when I was a junior in high school. I can't remember. Okay. And they gave you a percentage rate. Well, this is your math score. Well, it was between 0 and 100. Okay. So that's a percentile. And so what this is telling me, this IV percentile is telling me is, where is that? Where's this in relationship? Where's the current implied volatility in relationship to its high, which is about there probably, and its low, which is about there? Okay. And if it's mid-range, maybe this is a little bit higher than mid-range, then it's going to be a little bit over 50%. 50% would be right in the middle, smack dab in the middle. If you took your SATs and you got a 50th percentile, that means half the other students scored better than you and half scored worse than you. Okay, that's what this column is. And what I sorted by this column here, because what I'm saying is I'm not as much concerned about the overall implied volatility. I want to know where this implied volatility is compared to its own history, with the assumption that if it's super high, it's more likely to go back down to a more normal level. Okay, I'm hoping that is answering your question there, Thea. Good question there on that. Okay, so On Meta, we've had quite a year, right? There's, up 70% this year. But now we've had a pullback, and my assumption is it's not going to continue up at the same rate in the near term. But we may get a little bit of a bounce here, but I'm going to assume we're going to be a little bit more neutral right now. We probably have some support down, probably some support down in this range. Okay, I'm going to call that kind of down there. We probably have some more resistance down there. Assumption is we're going to stay in this level more. So I'm going to assume a little bit more of a neutral posture on this. But realize you can skew it on say an iron condor, a more of a neutral trade. So let's do this. Let me go to trade. I'm going to go to Meta. Okay. I'm going to go to Meta, and I'm not going to go out that far. I'm only going to go out, we'll go out a couple weeks, 14 days here. Okay. So January 3rd. And I'm going to use my delta again to try and help me inform me. I'm going to go out to roughly a 20 delta on this. So on my call side, I'm going to look at, we'll go say 625. I'm going to click on the bid price. I'm going to click on the 630 ask price. There's a short call vertical. I'm going to go to that put vertical here. Now, my put vertical, again, I'm going to go to roughly a 20 delta. I go to 570. I'm going to sell that one, hold down my control key, and I'm going to buy my 565. Hold down my control. That's an iron condor right there. Okay. So there we go. That's our credit. Now, when I click, we'll analyze this in just one sec, but let's do this math here for a sec. Max profit 166 divided by max loss 334 gives me about roughly 50%. So 50% return on risk. We're stand to gain about half as much as we could possibly lose here. Let's go back here though. I'm going to right click on this and I'm going to analyze the trade. So this is what our risk profile looks like. And this is classic iron condor risk profile. Looks like this, okay? And this right here, right there, and between there and there, that represents our max gain, kind of in there, that's our max gain. And these are going to be our strike prices, okay? So our strike prices are short strikes. So you get 570 is going to be here, 570, and this is going to be 525, it looks like. Or, sorry, 625. 625. Okay, so that's the goal, to be right in there. Now, that's fine. But if you want, keep in mind, these don't have to be equidistant from each other. And they don't have to be, here I have them $5 apart. 625 to 630 is $5 difference on the call side. 570 to 565 is $5 difference on the put side. I reversed that. That's the puts. This is the calls, but $5 on each of those. Furthermore, our current stock price is right here, which is kind of right in the middle between those. So this is truly a really neutral trade. Our delta is slightly bearish, but basically we're pretty neutral on this trade. And there's a couple ways to adjust this if I want. If I want, I could, if I shift my strikes up, instead of this looking like this, everything is going to shift over here. If I shift my strikes up $10, what this would look like is it looks something kind of like this, okay? And then with the stock right here, the current stock price, that would make it a more bullish trade, right? We'd have more leeway on this side. Another way to adjust this trade is instead of adjusting how far they are from the middle contract, we can also adjust the width of these. In other words, instead of $5 apart, if I wanted to make this more more of a bearish trade or more of a bullish trade, if I want to make this more of a bullish trade, you know, we've said we kind of have this more bullish bias here. What I can do is I can go to the put side here. Let me just bring this up a little bit so you can maybe see it a little bit better. There we go. And I'm going to make this 560. Now, before I change that, what I want you to think about is, how is this graph going to change if I lower this strike to 560 instead of 565? In other words, I'm going to have a $5 gap on the high side. I'm going to have a $10 gap to the low side. How is it going to affect my max loss? Number one, over here. Number two, over here. And my max gain over here. Before we do that, let's just kind of write down those numbers here real quick. So our max loss here is, it's kind of hard to see that green on the gray there, is about 334, okay, on that side. And it's going to be the same on this side. 334 is our max loss there. Our max gain here is about 166, okay, 166 max gain. So now let's change it. I'm going to change this to a 560. Ooh, did you see that chart change there? Now, what's our max loss on this side? Our max loss on this side is now 834. 834. That is significantly bigger of a max loss, potential loss. What's my max loss on this side? It is 334. Whoa, that did not, hold on one sec. Hold on one sec. I didn't adjust. I got to unlock that. Let's try this again. 772 is my max loss. 772 is my max loss on this side now. On this side, my max loss is 280. 280, okay? And my max gain is 220, okay? So let's kind of just summarize, because this is not, it doesn't matter whether we do it on this trade or not. I'm not really necessarily want to skew it that much on this trade, but in the future, you may want to skew these. You may say, well, I have a little bit, I want to take a little more risk to one side or another. If you spread out the width on one side, whatever side you see, whatever side you are widening it out, you're going to have a bigger, I'm going to just put a plus sign, max loss on that side. You're going to have less of a max loss on the other side, and you're going to have a bigger max gain. In this case, our max gain shifted from 166 up to 220. That's significant. That's that's not something to not consider. So we went from 166 to 220 on the max gain. On this one, the max loss went from 334 to 280. So not insignificant there. But this one you can see was very significantly affected. This one went from 334 to 772. Okay, 772, basically double, more than double. Okay, 772. So yeah, we benefit on two of these scenarios, but this one scenario is significantly worse than these get better. So, well, I don't know. I'm planning on this one. I'm just going to keep it neutral. I'm gonna go back and I'm gonna make these the same price there, and excuse me, the same width, $5 on each side, and give us a nice symmetrical iron condor there. Okay. So we're going to just go back. We'll just go back here, and I'm going to confirm and send. That's our neutral trade on this. Now, if I want, before I send this, I can put in exit points on this. I can say, look, I want to get out of this if my stock breaks down. Okay. If let's say we go all the way down here, or we break above, above here, above 630 or below 560, you can do that. And there you go. Now you may be going, well, 560 is below our low strike. That's not the end of the world, folks. The reason why is this. Let's say we go down to 560, okay? Here's 560, and that represents a max loss at expiration. But keep in mind, this green line right here represents January 4th. Hard to see. That's our expiration, okay? The purple line represents today. In other words, if we go down to this 560 level right here, if I go here, yeah, I'm losing, but as long as there's a fair amount of time before expiration, I'm not going to be at my max loss. So it still may make sense for you to exit at that point. So ultimately, if you are going to put an exit on these, and you don't have to, I mean, the reason we're doing it is we do have a defined loss trade, and maybe that's okay. But if you do put an exit in there, just put it in where you think, if your thesis is this thing is neutral, but if we start getting down here, I don't think this is neutral anymore. Therefore, I want to exit that trade. So I can go down here. Look, 555 up here, 640, something like that. You can add that in if you want. Just change your advanced order, single order, first trigger sequential, or first trigger is all, doesn't matter. You can right click on it. You can create an opposite order. And on this, you're going to change it to a market order. Make it good till canceled. I don't want this to go away at the end of the day, which is in less than an hour and a half. And you can click on the little gear. On that little gear, I can then just say, oh, Meta, if it goes down to, if it marks less than or equal to 555, I'm going to get out, or click right below that one. I'm going to say if it's greater than equal to we said 630. 630, that's going to get us out on the high side. Save that. There we go. And then if we send this, make sure you read it, right? Just because it says, we're saying, well, we're getting out those prices. We don't know exactly what prices is going to fill at, right? And so just be aware of that. Make sure you read your red notes down there. And there's an iron condor. That's a more neutral trade. That is filled. And now, if we have this, even though we have exits in here, we may get out. We're probably going to look to get out once we get inside the, we're only starting with 14 days to go to expiration. But when we start getting near expiration, a few days before expiration, we're probably going to look to close it regardless. And we're going to look to close it if we've made most of what we can make. Now, the thing with iron condors is they're slow-moving trades typically. Here's Meta. It's a very slow-moving trade. We're up $1.50, but it's not common, not uncommon to be a week into the trade and it's only moved $5 up or down on you. Just because you're dependent, if you think about options, how do you make money on options? Typically through stock price move, delta. Okay, the stock prices, your delta on your option gives you a move. Okay, but sometimes you can move from just time decay, so theta. And with an iron condor, delta isn't really, it can't move that. We're already at a position where we want to be at in terms of that. So delta is just, it's not going to help us much on this. Theta is just slower moving. It's a theta trade. Now on this one, we also have Vega, implied volatilities. We're starting off with a higher implied volatility. And if implied volatilities drop, then that should benefit our trade as well, and we should end up with better a better result if that implied volatility drops. Now that all goes to pot if implied volatility spike here on this. Okay, so here's our implied volatility. It's not super high, but it's higher and going lower. We're going to be much better off if implied volatilities end up down here than if they end up here on that. Okay, so there we go on that. There's your there's that. Let's check how we're doing. Okay, we're running low on time here, so I don't know that I'm going to do another trade, but let me just mention this. If you are looking at the markets right now, let me give you an example here. I have 100 shares of Bank of New York Mellon right now. Okay, 100 shares here. And maybe you are maybe you're going, well, look, we've had a good run. It's been nice, but I'm a little concerned about this pullback in the market. I'm concerned the new year is going to give us some challenges. Well, on a stock you already own, you may consider adding options in to help you. Okay, you could do what's called a collar. Okay? We have higher implied volatilities right now on this. And so we're going to look to, you could look to sell a call. You could look to buy a put. Now you're going to be paying more for that put because of those higher implied volatilities, but you're going to receive more for the call, for the short call, because of those implied volatilities. So these two can largely offset each other. Now, and so that can protect you if this drops, if it's a stock that you want to hold on to. Okay. I currently have a stop on there. I could close out of that stop. I could put in a long put. I put BP for buy put. It could be long put. I could put in that long put there to help protect us on the downside if it's a stock you already own, and pay for it by selling the call. Now that sounds like a great strategy, doesn't it? Well, there's a downside. The downside is that we're also limiting our upside too. Let's say we sell a call up here around, I don't know, about 82 or something like that. Well, that's great, but if the stock goes up, we may regret that we're selling the call there. Okay, so that's the downside of a collar. But if you're worried about it, that's a strategy to protect yourself on this. So let's just look at this on this trade here. I'm actually, before I do that though, I'm going to close it. I'm going to get rid of this stop loss, and I'm going to throw in a collar instead. And then we're going to have to call it there. So let me go to the trade, and I'm going to go out a little ways. I'm going to go out a month here on this to try and take beginning of year volatility if indeed we hit that. We said, around 82 or something like that. I'm going to look and see what we can sell that for if we go up. Well, we got 82.50. I can sell that for about 60 cents. So I'm going to click on the 82.50 call for January 17th. Let me just shrink this down here again. I'm going to go to a 72.50 put if we drop. And I'm going to hold down the control key on this. And basically it's saying this is not, essentially, it's not going to cost us anything up front on this, the way that is, if we get filled on that. I can confirm and send. I can then, let's see, that was in my, that's in my other account. So let's make sure we match that up. Okay, that filled. Now, when I look at this, what I have here is I have a 100 shares of stock bought in 2 different lots. We have a short call, a long put. We paid the same price that we sold. We paid the same price that we sold the put for. So it didn't cost us anything up front. Our time decay cancels each other out essentially. time decay essentially cancels each other out. And there you go. So, and that's going to lower the delta significantly on this trade. Now, if it goes down far enough, it's the delta will go up on that put the further and further it goes down on that. Okay, so that is that's a way to protect an existing portfolio if the current volatility in the market has you concerned there a little bit. Okay, all right, everybody. So, hey, thanks for joining me today. We looked at implied volatilities today, and we focused more on short options because of those higher implied volatilities. Short options benefit if those higher implied volatilities go down. Well, if the market drops a lot, they may not go down. They may continue down. But want to thank you here for that today. Now, coming up next, we got ThinkScript studies. So make sure you check out that class. Thank you, James, for helping me out. I wish you all a wonderful holiday season here. And I'll see you in 2 weeks from today. Bye-bye, everybody.